Hello, this is John Polemy of the Actionable Intelligence Alert, and this is the commencement of our interview series of various people in the junior resource markets. Our first guest to kick this off is Justin Huhn, who's also known as Uranium Insider on Twitter. And I've been following Justin's work for quite a bit of time, and I wanted to get him on because, as everyone knows, I'm mostly a generalist investor, and I try to follow the Charlie Munger view that I try to find the best and smartest people in a particular field and then kind of investigate their ideas, because no one's smart enough to invent everything themselves. So Justin struck me as a person that's done a lot of research and has some great views, in my opinion, on the uranium market. So I wanted to bring him on, and he will be guest number one. So welcome to the show, Justin, and thanks for coming on.
Thanks so much, John. Yeah, it's quite an honor to be the inaugural guest for your show. I'm a big fan of your work as well, so thank you. Happy to be here.
Awesome. I guess the first thing I wanted to ask you is kind of for you to give a little bit of an introduction as you feel, say as much or as little as you'd like about yourself, but mostly would like to understand a little bit about your background, how you kind of got into investing or got the investing bug, and then what drew you specifically to uranium and really doing deep research into the uranium market.
Sure, yeah. I'm just a private retail investor. I've been in the markets for about a decade or so. I spent the bulk of my investing experience, let's say the first 5, 6, 7 years, as more of a momentum trend following trader. I learned a lot about trend following and technical analysis, and did pretty well with that. But at some point, I just didn't really like the complete absence of fundamentals. Something never really felt right about that to me, and I started to sort of introduce kind of the fundamental story of stocks that I were interested in on a technical basis. And I really liked combining the two, and found that I could increase my success rate with technical trades if I felt confident in the fundamental story behind whatever stock that was I was technically trading. And yeah, at some point I just became of a uranium thesis. I think this was in 2016. It was from a podcast from Frank Curzio, the Wall Street Unplugged, and if I recall correctly, it was Jordan Trimble from Sky Harbor Resources was being interviewed. And something, I don't really know why, but something kind of just struck a nerve. There was something exciting about an inevitability of the turnaround of a market that was pretty beat down. And there was also something just very low stress that was attractive to me about contrarian investing. And maybe it doesn't work for everybody, but for me, it was being early was completely fine. And I think it's because I like to scale into positions, and that's what I've done for the past 3 years or so. Just slowly scale into positions within this sector as I continue to deepen my research into the sector and continue to have a bullish outlook for the mid to long term. So yeah, the story for uranium is fascinating. The sector is absolutely incredibly complicated and deep and layered and endlessly entertaining. I learn something new every day, and that's not a joke. I'm humbled constantly, and it's just kept my attention for years at this point. And so I started the Twitter page Uranium Insider, and slowly built up a following just from sharing ideas and learning and communicating with that community there. It's been awesome. So that's kind of brought us up to today. I started a newsletter last summer that's been going wonderful. I have a really awesome community there, and it's focused on uranium sector, junior mining sector, and that's brought us up to this point.
Awesome. That's one thing I kind of noticed about your work in following some of your tweets on Twitter. I did notice a lot of, not a lot, but a big influence of technical analysis And I think that's one of the mistakes that I'm trying to get away from, is trying to incorporate more of that in trying to identify the bottoming process and then actual breakouts, because I think one of the things we find in these beaten down markets, they take a lot longer to turn around than we think. And I think, and I'd like to get your view on this, maybe bringing some technical analysis to it. I have some background in that, but to try to lower the opportunity cost or get in too early. Any thoughts how exactly you incorporate that, or are you more on a beaten down market like uranium, just build your position and understand the inevitability?
Sure. Yeah. I think the way that I approach it from a contrarian perspective, whether it's uranium or any other sector, would be doing fundamental analysis on individual companies, finding the ones that I'm interested in, and then looking at the technicals and sort of trying to determine a place to start to scale into. There's a number of prominent equities in this space for the past year, even 2 years, have been essentially falling knives, and it's very difficult to catch a falling knife. And so you almost want to see a bottoming process. And while it's impossible, I mean, the other thing too is that nobody perfectly picks the bottom, like nobody does. And so going into a contrarian investment, you have to be okay with that, with not catching the bottom. You have to be okay with being down 10, 20, 30%, even more. And one way to avoid doing that is to recognize that the bottoming process can take a lot longer than we'd like it to, and to actually scale into your positions in tranches and not just go all in. If it's a contrarian play and you're not sure about whether that's the bottom, don't bet your entire portfolio on a single stock or two stocks that people just happen to like on social media. You have to be a little bit more intelligent about it and take smaller bites, scale into it, knowing that, maybe when it takes off, you might miss the absolute bottom, but, this thing's not going to go up in a straight line either. So pullbacks in an uptrend is another safe way to do it. So you can actually avoid almost the entire sector at this point. There's, with few exceptions, almost everything is in a downtrend or a bottoming process right now. So you could actually wait for a technical breakout and then buy the pullback, even if you miss the absolute bottom. But for me, and it all really depends on what you're comfortable with. So for me, I'm perfectly comfortable with being down and just continuing to scale into the positions that I like. But, finding those companies that you like fundamentally is probably the first step, and then looking at technicals to determine when to scale into a position.
Very good. I mean, I did notice, for example, I think late last week, especially, we saw Cameco. Looks like it may be breaking out on some decent volume from a descending trend that it was in, but these things take time to develop, obviously. Let me get your current view on the uranium market, where you are in your mind with regards to supply, demand, or what fundamentals you're looking at, because there seems to be a great deal of consternation, let's put it that way. I don't feel that way. I'm kind of willing to sit because I have the fundamental story, I think, figured out. But a lot of people that are new entrants to this market, or don't understand a contrarian mindset, or understand that sometimes these markets take longer than usual to turn around, what's your current thesis or time frame? And obviously, no one can actually know the exact turning point or the catalyst, but with all of I hate to say this, there's a lot of people are wasting a lot of time and effort, I think, just because of the boredom of waiting for this thing to turn. But what's your current view?
My current view is that the fundamental situation for uranium has never looked better on a mid to long term. So I'll say I generally preface anytime I speak to somebody new about uranium, it's like, this is a 3 to 5 year or more investment, and timing the short term is incredibly difficult and kind of a crapshoot. But mid to long term, I think it looks really, really good. I really like that the WNA fuel report that came out in September is very bullish for the long term, and I'm sure a lot of your listeners have already seen, some screenshots from that fuel report. or of the supply demand chart, there's the reference, there's the low case and the high case, and all of them show a supply and demand deficit, a supply deficit over the long term out to 2040. And I see that as not the primary reason to invest, but I see that as kind of like a foundation for the entire sector, like a foundation for the investment thesis. And all of that said, this is a very risky sector, and there's always the possibility of a black swan like Fukushima. Nobody knows whether something like that could happen at any day, and it could inhibit the sector greatly and affect your investment. So, big disclaimer there, it's risky, but at the same time, those situations are unlikely statistically, and I think the risk and reward is huge. And so you have this underlying supply deficit going out for a number of decades, and that's taking into account all of the reactors that are planned to come offline on schedule. That's taking into account all of the builds that are happening now currently and are planned, and that's also taking into account all the mines that are presently in production and could go into production over that time frame based on the expected rise in price. So they're basically saying, if everything plays out how we see it, even including all of these projects that could come online around the world over the next decade, we still have a massive supply deficit. And that's huge. And taking that as kind of a foundation for the investment thesis, I then start to look at more of a precise view of the investment thesis, which is the coming contracting cycle for utilities. So utilities, generally speaking, secure their fuel supply through long-term contracts, and that can be anywhere from 5 to 10 years. Sometimes there's shorter-term contracts for utilities that maybe have a planned shutdown that's not too far in the future. They'll plan to accumulate a bit here and there from traders, but long-term contracts are kind of the bread and butter, how utilities secure fuel for these reactors. There's no replacement for the uranium, and they need that fuel to continue to come in, and they need it to be secure, security of supply. So the last contracting cycle that was happening in the late 2000s with the run up in price, let's say 2005 to 2010, a lot of those contracts are starting to come offline now and continue to come offline in the coming years. So we have, between US and European utilities, we've got maybe a 5 to 10% uncovered within the next year or so, and that just grows from there, especially in the US. And so you have this situation where you've got, over the next 5 years, more than 200 reactors, potentially up to 250 reactors that are going to want to secure supply through long-term contracts. And there's a lot of variability in this market, so it's very difficult to pin down exact numbers. And for the sake of getting flack for not being precise here, it's just not possible to be perfectly precise in this industry. So you kind of have to do these back of the napkin sort of calculations that are good enough to get the overall picture. So we've got hundreds of reactors that will be signing 5 to 10 year contracts, and then you have to look at the offer. So what's really there to fulfill those contracts? This is not spot market, and we have the big producers right now. We've got Cameco and Kazatomprom, right? Those are the biggest producers, including Orano, which has JVs with both. So we've got all the major mines that are up and running right now. All of Kazatomprom's ISR mines. Cigar Lake is still running. That's a JV with Orano and Cameco. Well, Cigar Lake is mostly contracted out, and so we've got 180 million pounds at McArthur River that will come online at some point. We've got Kazatomprom, a percentage of their production, because they've got offtake deals with India and China and Russia. So there's only a percentage of their production that's going to be contracted. So sorry to make this too long here. I'm just trying to kind of paint a picture here that we've got basically potentially 1 billion pounds or more of uranium that's going to go into long-term contracts over the next 5 years. And we've got maybe 500 to 600 million pounds available on offer from current producers. Now, that's not including new projects that could come online. That's including what's currently producing and what's in care and maintenance. So we've got this big deficit even within what's contractable from producers that are online and could come online soon. So that's the primary thesis. We've got 500 to 600 million pounds that could be contracted, let's say, in the $50 to $60 range, and a good part of that could contract even in the $40 to $50 range with Cameco and Kazatomprom. So what happens after that? That's the big thesis. You need way higher prices to incentivize any of these new projects to fill the remaining gap in that contracting. And so that's the primary investing thesis for me. You have this underlying, just beautiful long-term supply-demand situation, and then you've got the coming contracting cycle that's potentially going to have a serious deficit until prices incentivize new projects, which we're talking, the next tier up after Kazatomprom, Cameco, Kazatomprom, Orano, and perhaps Paladin with Langer Heinrich. Then you've got higher prices to bring anything else on. So that has to happen. I mean, these reactors need their fuel. So that's kind of the primary thesis for me in a nutshell. Hopefully that wasn't too rambling or complicated.
No, I mean, it was pretty straightforward and easy to follow. One of my concerns and what I'm thinking about on this is to add flavor to this is, I mean, I think nuclear power, at least in the United States and Western Europe, but even when it comes to China or Russia or some of these other countries, it's a highly politicized fuel, if you will. I think that the governments are very involved. And when I see this move around the world to less globalism, more nationalism, more, especially with a country like China. China, when it decides it's going to do something, this goes back even to the previous bull market in commodities and resources last decade. When they decide they're going to do something and they put it in the 5-year plan, it just gets done. So I have a view that, there's going to be a scramble, if you will, because I think what has happened is, and people forget, is incentive pricing has not existed for over 10 years. I mean, after Fukushima, prices collapsed, and we've had this air pocket where we're basically, in my view, living off the investments that were made in new mines and production capacity a decade or more ago. So we're in this situation now because incentive pricing is not high enough. We have had this deficit of investment for almost a decade, in my view, or maybe more. And the market being as opaque as it is, with not a lot of good information, I think that, the herd instinct around fuel buyers and nuclear operators, at least in the West, I don't think it's the same in China and Russia, but in the West is that, well, prices are low, were low yesterday, prices are low today, so therefore, they have this recency bias that it'll be low tomorrow. So I think I have a view, at least, and I kind of want to get your take on this, is that I think there's a good possibility there may not be enough fuel for everyone if things go the way some people are anticipating as far as the build outs and stuff. I think that some people are going to get caught out in a musical chairs type situation, and because of the lag time it takes, that once you get to incentive pricing, whatever that is, $50 a pound, 60, whatever that ends up being, the time frame it takes to get a uranium mine permitted, built, and plus all the crap that goes along with junior resource development and mine development. I mean, like I've said before, everybody tries to wreck the project while you're trying to develop it, build it. Anything can go wrong usually goes wrong. So you're looking at 10 to 15 years for any new development. I guess it could be accelerated in some jurisdictions, but I think do you share the view that there could be a kind of a musical chair situation where there's a demand for a certain X amount of material, but it doesn't exist, and that could cause a price spike?
Yeah, all good thoughts, John. I definitely see that as possible. It's difficult to really say. There's certainly no shortage of uranium in the world. It's just a matter of getting it out of the ground at a price that makes sense for each project, and those projects being able to come online in a timely enough fashion to fulfill all the demand. You're not the only one who shares that viewpoint that we could see a serious situation. I don't see this in the short term, even within a 5-year time frame, but we're talking, end of the 2020s, we could have a really serious supply deficit when it comes to actually powering all the reactors that are online at that time. Yeah, I see it as possible. I'm not necessarily personally predicting that. I just kind of feel like, I know how much uranium is available at the $40 to $50 range, like under 60, and we need another 400 million pounds within 5 to 6 years at a higher price range. And so that's a lot of uranium. That's a lot of uranium to come from projects that aren't producing right now. So we could see a serious situation in, that many years out. And in the meantime, I think you're completely right with the recency bias when it comes to traders, utilities. Just they've been able to access cheap uranium on the spot market since Fukushima, essentially, when that demand came offline from Japan, from Germany. All of the production that was going on was still just pumping it out. That didn't come offline until let's say 2016, 2015, when some of the higher priced mines just started to slowly come offline. But and a lot of the production that was happening, even as demand was falling, was filling those contracts, like you mentioned, that were signed, in the late 2020s. But then you had Kazatomprom that was essentially just dumping into spot. It was a currency play. Their currency was devalued. It was also, like you mentioned, the geopolitical play. It was multifaceted. One part of that being essentially killing the United States and many other uranium production. And so now you have Kazatomprom acting definitely differently and in line with what they've promised so far. They are not selling into the spot market right now, and that's confirmed. So that's a really big change. We have very few spot market suppliers right now. So my feeling, I think your previous question, I didn't really answer it. I got too deep into the supply and demand situation, but my feeling is that the spot market is relatively thin, and I think it's thinner than the utilities are aware of. And we're going to know that this coming year in 2020. So we're going to know exactly what's out there on spot, because we assume that the working group for the nuclear fuel working group that was appointed by Trump, that's going to be over with relatively soon, and we should see some more spot market action. So if the spot market is thin, we should see the prices of spot uranium rise, and we should see that incentivize some of the utilities that are starting to become uncovered out into the future, sign more long-term contracts. So I see 2020 as being potentially the year where we confirm that the market has tightened and the turnaround is happening. I mean, we're already seeing it in the fuel cycle. We're seeing every piece of the fuel cycle in an uptrend. And spot's lagging a little bit from the UF6, from conversion, from SWU. So all of these back-end fuel cycle metrics, they're all rising, but spot is lagging slightly, even though it's up, almost 50% from its low. And the equities are, of course, lagging everything. But I think 2020 is the year it turns around, but I don't expect fireworks necessarily until 2021, let's say to 2023, 24. I think if I had to pinpoint and put my thesis out there on timing, I think now and over the next year, dips over the next year is just an amazing time to accumulate if you have the ability to sit tight for 3 to 5 plus years on a contrarian investment.
Yeah, agree wholeheartedly. I'm glad you spoke to the other parts of the fuel cycle and the pricing that's tightening in there. That shows us that demand is increasing. Eventually, will pull the uranium price higher. I don't want to get too far into the whole underfeeding and all that stuff. It gets pretty complicated for a lot of people on the fuel cycle. But suffice to say, I think many people have noticed and published information out there that you understand the fuel cycle and understand that pricing's tightening along the fuel cycle. So I guess what I wanted to get into next was the investability. I look at this more of a speculation. I'm not sure, I try to differentiate between investing and speculating. Investing, I guess you could say, you could buy Kazatomprom, it pays a dividend, it's kind of profitable, it has some cash flow. So that's kind of investable. Cameco is investable in my mind to a certain extent, although I think they have some risks. But when you start getting down into the juniors, which I think a lot of people are focused on, and here's why, we both know this. there's a lot of guys out there, a lot of people, mostly guys that are doing this, younger guys, not a lot of experience, and they've heard the hype. I mean, the hype started a few years ago. We've got into these doldrums. We're like stuck in the Sargasso Sea here with no wind in our sails, and the crew is getting frustrated and ready to mutiny. So, what is your view on these juniors? Because I have a view, and I'm just going to make a couple statements, and you can corroborate them or, feel free to give your view.
Sure.
I have a lot of experience messing around with junior resource companies. I mean, these are just terrible people for the most part. Not all of them, of course, but there's a lot of bad actors here. There's a lot of people that are lifestyle CEOs. I'm not going to get into names. In my video last week, I kind of dumped a little bit on UEC and the URC being public this week. But
right.
What investability what to you is some of the major factors that you look at when you're looking at these junior companies? Are they even investable at this point? What are the real risks? Because I think a lot of people just think, well, I'm just going to be, I look at the last bull market and some of these companies went up 1,000, 5,000, or like Mega Uranium. Some of these things went up 10,000%. They hear the stories of Rick Rule and Paladin Energy going from 8 cents to $12 or whatever it was, $16.
Right,
I can't remember.
right.
But anyways, so everybody has visions of sugar plums. What's your view on this? How do you allocate money? You don't have to get into particular names, but you're talking about 40 or 50 companies here. How do you siphon through the dross and get to the quality names?
Yeah, great question. I mean, to answer one question that was within that longer question, there are very few, in my opinion, investable juniors in this space. And there are a few companies that I'm not going to name, but I would just call are bordering on fraudulent and taking advantage of shareholders. You really just have to dig into it. I'll also say that if you're interested in this sector and you're not willing to do the work to dig into the financials and into management and all of that of the junior mining companies, there's nothing wrong with just buying uranium participation, yellow cake, or even one of the new ETFs like the URNM, the North Shore uranium ETF that just launched last week. Nothing wrong with that. The uranium participation just tracks the commodity, and it's a great way to expose yourself to the commodity in the cycle without taking on the risk of all of the risks that go along with junior mining, dilution and sleazy management companies and things like that. So, I always look at management first. I mean, I think that's by far the most important. This past year has been a real eye opener for me. I feel like I've dived deeper into looking at different aspects, especially the financials. And this stuff is really important, especially at the beginning. If we start to get into an uptrend, you can just close your eyes and throw a dart at the board, and whatever you hit, it's going to be going up. But like I mentioned, I've got a pretty good a blog post on my website called "What to Look for in a Junior Mining Company," and that's uraniuminsider.com, and then on the blog. And I kind of line out all of the things that I look for in a junior mining company, but management is always number one. So I like to see what they've done in the past. What have they accomplished in the past? Is it noteworthy? Is it something that's impressive? How have they acted in their previous companies? Is there any dirt you can dig up on them and try to dig up dirt on them? Try to find interviews, call the company, talk to the CEO, talk to investor relations, get a sense of that. You can really get a sense of somebody's character just by hearing their voice and hearing how they answer your questions or dodge your questions. Don't be afraid to ask the hard questions. Nearing the bottom of a commodity cycle that we're in right now, it's way more important in a downtrend or in the bottoming pattern to look at dilution, look at capital raises. Where are they spending that money? What are the salaries? There was a video interview with Rick Rule that I watched, and he was talking about gold and silver companies, juniors, but I think that it applies to uranium as well, where he mentioned that there was a study done over a number of years of, I think it was 1,000 junior mining companies. And they looked at percentage of capital raised that was spent on G&A expenses. So just like general administrative salaries, things like that. And the average was 65%. That was the average. So even if that's remotely close, that's just, I mean, if a company is not producing cash flow, you as a shareholder are funding their operations. You're funding their salaries. You're literally paying their salary. So you need to find out what that salary is, and you need to find out if you're okay with that based on what they're providing to you as a shareholder. I mean, some of these guys really need to be held accountable. But there are some companies out there that are being very respectful of shareholders, and they're diluting minimally. And the majority of the capital that's coming from those dilutions, from those capital raises, is going into the ground. It's going into exploration. It's going into project acquisition. There obviously are going to be some G&A expenses for every company. But I think that doing the work to dig into that is really important. Like I said, especially when the stock is in a downtrend or in a bottoming pattern. It's once the capital starts flowing, when this thing does turn around, it's going to come in from all sides, and they're going to have no problems raising, and dilution becomes less of an issue when you're in an uptrend. But it's a major thing to pay attention to right now. So yeah, management, look at the share structure of the company. How many shares do they have now? How many shares did they have 2 years ago? Dig that up. Go into the news section of the company's website. Look at their capital raises over the past 2 years and the share count of the company. Find out what they spent that money on. If they're diluting and they're bringing value to the shareholders, then the dilution is not bad. If nothing has changed for the company in 2 years, but you've been diluted to 40, 50, 60% in the course of a couple of years, maybe you don't want to support that company. Consider as if you're going into business. I think that you might have said this, John, in one of your previous podcasts, and I really like that. Just consider like you're going into business with the company. And anybody who's ever run a business or had some type of partnership, that who you're partnering with is by far the number one thing to consider when you're doing something like that. So yeah, those are obviously the most important things to look at. I mean, in my opinion, those are way more important than the assets. I'm not going to mention names, but there are some companies out there with absolutely killer assets, and I think that their cash burn rates are just reprehensible, and I won't touch them with a 10-foot pole. No, I just can't do it. So I like a company with good management, with a history of providing solid returns for shareholders, with as little dilution as possible, and with at least decent assets in good jurisdictions. So that's really what I look for the most. And yeah, I would encourage folks to check out that blog post on my website too, because I go a little bit deeper into all those points.
No, I think you're right, and I agree wholeheartedly. I mean, management, to my mind, is the most important facet of success with any company, goes without saying. And just from my own perspective of doing these construction projects in the energy industry, I've seen terrific projects be ruined by poor management. And then conversely, I've seen a mediocre project where you have an outstanding management and they're able to get every bit of value out of the project. So I think one thing people need to consider, I've encouraged people to do this. I've done it several times, and it was eye-opening many years ago, actually now about 10 years ago, but should take a trip to Vancouver to one of these conferences that they have up there that's sponsored by Rick Rule or some of these other folks that they have, and they invite all these junior companies in and just walk around and have conversations with these people, because they'll talk to you. I mean, you could talk to Rick Rule if you get up early enough. He's sitting over at his booth at 6:30 in the morning. So, I mean, you could talk to these people, and then you start understanding that kind of what George Carlin said when he was referring to the power structure in the United States, but kind of applies here too. It's kind of a big club up there, and you're not really in it. So you really have to beware, to your point, and do the research. And I think that's what you're doing. I mean, I think people approach a lot of the, not just resource investing, which is very cyclical and very profitable if it's done correctly, but they approach it as like pitching pennies or flipping baseball cards when you are actually a part owner of the company. So I think if you go in with that mindset, but it takes work. I mean, you and I both know it takes work. You have to dig through things. You have to go to CDAR and get into the 10Ks and 10Qs and the submissions, see what these guys are really doing, dig down, call the company. You know, I mean, you can go, if you don't like the fact that Amir Adnani's taking a big salary, go to a conference and get in his face because he stands at his booth all day. I mean, other people have done it. So, you know, I mean, these are things that have to be done. So I like your suggestion. I think for the generalist investor or somebody that, and I said this last week, and I've said it a couple times in several videos, you know, these ETFs that are coming out now, before, you know, they destroyed the people that were running URA, destroyed it by basically putting a bunch of companies that didn't have very much nuclear exposure in there. But these new ETFs by Horizon and the new one that came out last week, I think are excellent vehicles for, you know, they're market cap weighted. So you're going to get a lot of UPC, you're going to get a lot of Kazatomprom, Cameco. So you're not going to get hurt. You're not going to get the 10,000% return, but, you know, I think, you know, you are going to definitely outperform the S&P 500 over the next 5 years if you know, look at something like that. So I think that's excellent advice. And I think, I mean, to your point, I mean, Uranium Insider, you have a blog, you have, you know, you have a newsletter, you do this work. It's a lot of work, and it's very hard to get information. It's an opaque industry. I mean, for heaven's sakes, I mean, when we first started having the cuts in production over a year ago, if that was something that happened like in the oil market, the Saudis just came and said, we're going to cut 10% or 15% of oil production, world oil production, I mean, the price would double overnight. So I think price discovery in this industry is not very good, and the information doesn't flow as well as people as it does in other industries. But point well taken. I think, you know, junior markets are, I mean, that's an excellent stat. I mean, you really have to siphon through the BS and what I call the lifestyle CEOs. And, you know, I remember way back when, this is many years ago, when uranium, before it even took off, you know, the question was asked by Doug Casey one time on an interview I heard him on. It's like, how many actual competent uranium teams are there? I mean, a lot of people like to jump around. You just can't grab a geologist that spent all of his career in copper or gold mining and just dump them into a uranium mine, because it could be hard rock mining, it could be ISL type mining. And I think that you really got to kind of understand who are the people, because this industry is an old industry. It's went through several cycles. A lot of properties have been recycled. You see a lot of that kind of crap going on too. And I don't think people are necessarily aware that, you know, they watch a YouTube video of someone that's been in the industry before. What does that mean? I mean, to your point, have they actually been successful and created shareholder value in previous cycles? So yeah, definitely.
Yeah, good points.
Let me, so, I mean, what is your methodology? I think you touched on it a little bit just for researching some of these uranium juniors. I mean, what advice, you kind of touched on it a little bit, but, you know, if somebody really wants to deep dive this thing, how can they siphon through, besides what we talked about? Do you have a set methodology that you use, or a checklist, or a way to categorize these 40 or 50 different companies and, you know, put on whether they are investable or not? I wonder if you give a little bit more light on that.
Sure, yeah. Well, I can only speak for myself personally, because everybody's going to have different goals as an investor, right? So, or speculator. They're going to have to factor in age and how much they're investing, what their risk tolerance is, how much time they want to spend researching and keeping track of the market, keeping track of their positions. But for me personally, I'm instantly attracted to the juniors. I'm looking for maximum upside. I have high risk tolerance, and I like to find junior mining companies that can provide the most upside potential as possible. So I wouldn't suggest to anyone to shy away from the mid to, you know, even the large cap companies in the sector are so small, relatively speaking. At least right now they are. You know, there's nothing wrong with buying ETFs, buying the pure play like you know, yellow cake uranium participation. But I'm personally drawn to the juniors, so I usually start with just like a market cap filter. You know, I look at if it's under $50 million market cap, I get interested, and then I just go from there. So I'll start to research, look for interviews, you know, do a YouTube search for interviews with the company, filter by upload date to get the most recent. Then I'll go to the website, I'll look at news releases. I'll start to dig into financials a little bit. What I like to look at in the financials is mainly the cash position. So I look at what was the cash burn for the past year. And then I start to, if it's substantial, then I start to look at what did they spend that on? What's their debt like? How much cash do they have on hand? I'll go to the news releases and look at their capital raises, see what they spent that money on, like I mentioned. And then I'll look at things like share count, and I'll just do as much research as I can in that manner. I'll search for it on Twitter. I'll find some other people. There's a function on Twitter where if the company has a Twitter page, and some of the people that you follow or that follow you can also see that they follow that company. And so what you can do is send a direct message to your peers on Twitter and just say, hey, I see that you're following this company. You know, what's the story here? Just do everything you can to dig into each individual company. And then there's other, you know, you or I, we both have services where we provide, you know, we've done much deeper research than most people, just the average retail investor, at least in this sector. And you've done deep research in other sectors as well. And then you've gone into shipping and oil and things like that, which I'm also very much interested in. So you can pay for services as well, like the ones that we provide, but nothing replaces your own due diligence, because when it comes down to it, if you take positions in companies, you know, this thing is not going to go in a smooth straight line. And you have to have a plan for how you're going to hold companies. If you're planning on swing trading them based on peaks and valleys, you got to have a plan for that before it happens. Because if you don't know the why of why you purchased a company, then you're going to have a hard time holding it through what's going to inevitably be a very volatile cycle. But yeah, I like to just search for anything I can find on YouTube, anything I can find on Twitter, and a lot of times the companies will have good interviews with, you know, Crux Investor. He's also on Twitter and YouTube. Smith Weekly's done some great interviews, and you can really get a better gauge for the company through these channels.
I definitely agree. One of the things I think what I find invaluable, and you mentioned it, is the Twitterverse, if you will. I mean, Twitter is not really like Facebook. I try to talk to one of my friends about this. He's like, I don't want to get on. There's a bunch of nitwits on there and stuff like that. And I'm like, no, it's not really like Facebook with cat videos and babies, you know, and balloons. It's if you get into these uranium Twitter and finance Twitter, there's a lot of guys out there that, you know, have 2,000, 5,000. I think, didn't you just crack like 5,000 Twitter followers or so? I can't remember. Didn't you have some kind of
I did, yeah.
milestone?
Thank you. Yeah.
Yeah. Congratulations. But that's
Thank
what
you.
we see. We see a lot of these guys. I mean, some of them are like big name people. I mean, that, you know, you can get access to, and you start interacting. Even if you want to lurk, you just pick up on a lot of information that you may not see yourself. I mean, there's a guy, I think that's kind of the yeoman scribe of the uranium, John Quakes. He's gonna catalog every single piece of uranium information that comes across every day. I mean, guys like that, you just fan out and start realizing, you know, people that are doing good work. And I think it's invaluable. I kind of encourage people to get on Twitter and at least start building up their contacts. Because you can DM people or interact with them, and they interact back. And I'm surprised at some of the people that I've had contact with or been able to speak with. You know, Michael Alkin, I've been interviewed by him. I talk to him occasionally. So, I mean, it's kind of interesting, you know, that people I think don't use that resource. But trying to transition a little bit now. Want to get into, we're getting near the end of our time, but I wanted to talk to you a little bit about, you know, we've talked about, you know, visions of sugar plums and how great it's going to be for the uranium market over the next 5 years. But I always like to do, like they do in military, before they do an invasion or some big thing, is kind of red team it, where I take the other side and say, what are the holes in this plan? What are the risks? I mean, obviously another Fukushima is out there, but what other risks are you looking at, uh, you know, as it applies to the long-term thesis?
Yeah, that's always a good thing to do. I'm constantly, anytime any thought of a bear market thesis comes about, whether it's just from my own thinking or somebody presents it, I definitely give it the time of day. I think it's really important to look at the other side of the trade, especially a fundamental trade. And well, obviously, like I mentioned, there's always that chance of a black swan event, such as Fukushima. So any type of meltdown, it's not necessarily going to kill the market immediately. The big thing that killed the market after Fukushima was all the reactors that were shut down. Japan shut down, was it 53 or 54 reactors in short order after that, and Germany followed suit. They shut down all their reactors as well, or most of them. And so that kind of killed the market. It wasn't necessarily the event itself, but that's something to just watch out for. It could happen. I don't expect it to happen, and I have my money betting on that, but it's always a possibility. I think that a broad market recession could have an effect, but I think that it has a caveat that I believe that if the spot market is moving up consistently during a broad market recession, that uranium could actually be kind of a bright spot and a place that capital can kind of find a safe haven during a broad market recession. So, but if spot is flat, the uranium equities are going to get hit too. I tend to not make predictions about broad market recessions. I don't really, I know how to play put options, so I'm just going to watch the S&P and the Dow technically and buy put options when the time comes and have that as a hedge. I don't plan on selling my uranium equities. If there's a broad market recession, I'll probably just buy more if it drops, because unless something changes the fundamental story, I don't really see a reason to sell. But that's another risk. And then I guess, any other drastic negative change to the demand story could not necessarily alter greatly the supply demand situation, at least for the mid to long term, but it could affect investor sentiment and therefore the equities. So if you have, and I don't see this happening, but if you have China just announce something like, oh yeah, we're not going to be building reactors from 2025 on because of XYZ. I don't expect that to happen, but you got to watch out for that. If the demand situation drastically changes for the negative, then that could certainly affect the equities and investor sentiment at the least, and potentially affect the long-term supply demand outlook. All of that said, the other bear thesis are Kazatomprom is just going to ramp up production. It's like, well, it doesn't even matter. If they could put unending capital into ramping, they could bump up another 20%, and it's just not going to kill the market at this point. The demand is too great, and the contracting cycle is going to need more than they can provide in a ramp. So can they? Sure. Will they? I don't think so. They're borrowing money to pay a dividend right now. So even the lowest cost producer in the world, while they're producing good cash flow for sure, they're promising a dividend as partially a public company now, that they're having to borrow money to pay. So it's not as rosy as it looks for Kazatomprom. So I don't see the Kazatomprom ramping theory as one that can kill the market. Other people have said things about, Chinese inventory. The Chinese certainly have a massive inventory. They've accumulated much of the oversupply of the past 8 years. And so we assume that they have somewhere in the ballpark of, let's say, 350 million pounds of inventory, but they're growing like crazy. And, their reactors are essentially state-owned or owned by state-owned corporations. So that's a strategic inventory. We don't expect them to ever just sell that into the spot market. Could they? I don't know, I suppose, but it's really not something that we're expecting. I don't see why they would, considering their growth plans and the demand that they currently have, even from the reactors now. So, there's certainly bear thesis out there, but none of them really have me concerned at this point. Just things to watch out for as far as the broad market sell-off that's probably going to come, a broad market recession, 2020, 2021, 2022. I don't really like to pinpoint that sort of thing, but we're getting a little long in the tooth there. You could probably speak more to that. But those are the main things that I'm watching out for. But I generally see the fundamentals for this sector as being phenomenal, and commodities in general. You know, there's other commodities that I'm on my radar: copper, nickel, and oil, things like that I'm seeking exposure to at some point. But my conviction for those is not as high as uranium, and I do believe uranium will outperform all of those sectors on let's say a 3 to 5 year time frame without a black swan.
No, I agree. Obviously, I like to be diversified, but I think one thing that you kind of touched on that I kind of wanted to just comment on, I think another thing people forget is that, and it's really funny actually, because I had a previous video like 2 weeks ago, I talked about the fact that you can buy all of the oil-related equities in the S&P, well, for the value of one corporation, which is Apple. So the valuation of Apple, their market cap, has now exceeded the total market capitalization of the oil industry in the S&P 500, which I found crazy. I mean, you're talking about an asset, a commodity that basically enables civilization and modern life. But I think how that applies to the uranium market is people don't understand something. I mean, you could conceivably, well, theoretically, you could never do it, but theoretically, you could buy the entire uranium public market for $9 billion, 8, 9, 10, whatever it is right now. So I think that, you know, once this thing really gets going, it's a lot of retail in there now, not a lot of big money. I mean, even like the Horizon ETF is only like $3 or $4 million. There's hardly any money in there. So I think when this thing gets going with algos, with screens, once the technicals start turning, you're going to start attracting AI. AI is going to pick up on it, and you know, especially if the pricing of uranium moves higher, it gets picked up, and then you start building momentum. And any kind of money, I mean, just to double the market cap of the entire industry would only take it to $18 billion. That's nothing when you're talking about the market cap of, like, you know, some of these large corporations like Apple, which, you know, is closing on $1 trillion. So, I mean, you know, at the height of the last bull market for uranium, I think the entire market cap was $150 billion. So it won't take much of once this thing gets going, it won't take a lot of money to really double and triple up, and you still would be, you know, at very low overall market capitalization. So I think it's something people need to keep in mind. You know, in gold markets, when I had experience with that from 1997 to the top, whenever it was in 2011 or whenever it was 2010, I can't remember. But I mean, you know, that was pretty exciting. But I try to tell people, like on the uranium side, even the last bull market, it was like every single week, Trade Tech or UXC would come out. Well, uranium was up another $2, or it was up $3.50, or it was up $1. It's like, does this thing ever go down? I mean, there was some extenuating circumstances, but the stocks were screaming. I mean, they were responding, and they will respond again, I think, once sentiment changes and once money flows start coming in to this market. So that's kind of a
completely agree. Yeah, I totally agree. And just really quick, part of that bullish thesis really is the lack of investable assets in the sector. You know, I think there's less than 60 companies total, public uranium companies that are investable. So it's just like, once the funds start coming through, they have so few options that it really, you know, the rising tide will lift all ships for sure. But over the course of a few years, you know, the cream will rise to the top. So I think it's important to invest wisely. If you're not just going to buy the UPC or the yellow cake, then you really have to look into it, because it will matter over time. You can take a shotgun approach or an ETF, and you'll do well. But the lack of investable assets is phenomenal. I mean, what was it? It was 300 plus companies in uranium space at the height of the last bull market, and now it's 60. So it's pretty small.
Yeah, that'll be kind of our contrarian tell. I mean, you see that all the time with a lot of these markets as they get into a boom. I mean, you'll see companies just start changing their name to just get uranium in there, and they'll start marketing a property that was, you know, previously marketed as a copper or gold asset. Now it's uranium. uranium assets.
Right.
That's kind of some of the nonsense that goes on up in Vancouver. So that's
Yeah,
buyer beware type situation. We're
for
coming to
sure.
the end of our time, Justin. I was wondering, is there anything that we haven't covered that you would like to get out to the listeners, or anything that we may have missed that you think is pertinent to this conversation?
Well, I thought I'd just mention really quick a couple thoughts on the working group.
Yes.
And by the
Yes.
time this
Go ahead.
airs, we might have new news on this potentially. But there was a leak last week from Bloomberg of the recommendations from the working group, and it seems like the market was pleased, especially when it comes to U.S. Uranium companies. They had some pretty big moves, especially URG, Energy Fuels, companies that sold off really hard in July after the 232 non-resolution. So some of that is just kind of a reversal, but certainly the market liked that leak, but we saw zero movement in the spot market. So I think what we're seeing is utilities and traders, they're still waiting for the official ruling. That a Bloomberg article leak is not going to be official enough for the overhang that supposedly exists, keeping the majority of traders and utilities from accumulating anything from the spot market. We did see some spot market action last month after the news of the Iran sanction waivers, but it sounds like Russia's kind of going to comply with that. So I don't really expect that to impact Russia or Russian-controlled supply. But it at least made utilities aware that there are geopolitical risks with supply. But back to the working group, considering that Trump appointed this working group, so 232 was sort of this arbitrary petition that was brought to his desk that was not of his asking, right? So you had Energy Fuels and UR Energy come forward with this petition requesting 25% quota for U.S. producers, and then let the chips fall as they may with how that would affect utilities, how that would affect the fuel cycle. And that, I think that they made some good points on the national security issue of where the United States utilities are getting their uranium. But I don't think it was the right solution necessarily. I think that Trump ruled correctly to not go with the quota and to implement this working group. So I have a feeling that the recommendations will be positive and that he will rule positively if I had to bet one way or the other. But I've maintained all along that I don't consider this as a tradable catalyst, but I do think it's a good idea to have exposure to the best U.S. companies, just in case it is positive, and because there are some very investable U.S. companies. Whether or not throw the working group out the window, I have U.S. exposure, and I think it's a good idea to have some exposure to the U.S. And hopefully we have that ruling within the next couple of weeks. I'm hearing a couple of whispers that people are saying that he should be receiving it. Trump should be receiving it within a week or two. We'll see. I don't like to bet on these things, and you never know timing with the government. They don't do anything efficiently besides take your tax money. But we'll see. We'll see how it turns out. And if it is ruled positively, if there is any amount of uranium that will be purchased from the Department of Defense or the Department of Energy as a strategic stockpile, it'll be a total boon for uranium equities in the United States or any U.S. producers. Cameco has a number of U.S. assets, and so yeah, I'm looking forward to that mostly being over with. But it could be a big tailwind for U.S. companies if it's ruled positively.
Yeah, I'm kind of with you. I don't like to talk about it too much until the news actually comes out. And I think I've seen a lot of speculation on what we could see out of that. I don't think it's, it could result in some short-term bumps, but I don't think it will be a material to the long-term view. What I do find shocking, and I think which, Trump realizes, a lot of people, people have their own views, but I think I'll just say the government now, the current regime, if you will, the fact that you have, 20% of the United States electricity is produced by nuclear, and we import, most of our fuel, or over 90% of our fuel, that's not smart. That's just not a good policy. So I think that the Energy Department, Rick Perry, and those folks kind of understood that. Wilbur Ross, those guys kind of understand those things. They're not actually as dumb as they appear to some people. People actually are accomplished in some things. So I think that from a policy and national security, I think that we'll see something out of it. One last question I would like to ask, because it kind of popped in my mind when we were talking about this, is what is Cameco doing in the spot market? I mean, it seems like they keep pushing off. They're in there doing things, and you hear different things from Geitzel on these quarterly meetings, or these like reread the transcript several times, and I'm having a hard time figuring out where they are in soaking up the spot. He said he didn't want to have Cameco be the only buyer in the spot market, but they have these contracts they have to meet, and they're being a little opaque, I think. Also, any thoughts on that?
Yeah, I think that they've got themselves in somewhat of a complicated situation where Tim Gitzel is definitely treading lightly. I think he's being very strategic with his words in these conference calls. And as far as I can tell, so I think that the general consensus amongst investors is that, well, it makes sense for Cameco to accumulate spot pounds as cheaply as possible, because they have these contracts that are at $45-ish, somewhere in that ballpark, right? And so they're needing, because they shut down McArthur River, they're needing to purchase some material from spot. I think it was 22 million pounds a year for this year and for next year, and really until McArthur is back online. And so basically the portion they have, their contracts are partially spot referenced. So I believe it's 60-40, and I always forget which percentage is spot reference and which is fixed. I think it's 60% spot, 40% fixed, but I could have that backwards. Regardless, they don't necessarily benefit as much as everyone thinks from buying cheap spot, and they benefit way more by having a strategic influence on the price movement of spot, because once spot rises consistently above, let's say 30 to 35, that's gonna get the utilities' attention to get some contracting happening, because they know that basically all the utilities assume that there's still a ton of material cheap on the spot market, and anyone that's kind of on the fence of any of the utilities that's on the fence of being uncovered, maybe they've got a little wiggle room with inventory, and maybe they think that they can grab a little here or there for spot and sort of pad those inventories and prolong the need to contract, because it's logical to think that, well, why aren't they just contracting now, given that WNA fuel report? They can see the writing on the wall 10 years down the road. Why aren't they just buying? Well, there's no incentive for the fuel buyers, for the utilities to be the first one to jump into the pond and sign a contract that's $10, $15 higher than spot. And if the market stays flat, then they're going to look really stupid for doing that, and they're not about to do that. They're not going to stick their neck out there. So I think Cameco, I think that they believe that there's enough material in the spot market that if they're the only buyer, it's not going to move it very much. And so that's kind of what we saw in September. In the second half of September, Cameco was in there buying a little bit. And we sort of think that it was mostly Cameco buying. They bought maybe 2 million pounds second half of September, and it moved the spot market up about $1. And that was something. But I think that they know that them being the only buyers in the spot market, it's gonna consume what's being provided to the spot market. You've got BHP from Olympic Dam that's putting in, let's say, 6, 7, 8 million pounds a year, that will continue to do that because it's a byproduct of their production there. And then you've got Uranium 1 providing a bit of spot pounds there. And so you've got some underfeeding and maybe a little bit trickling in from Japan, but you don't have a whole lot of annual spot material coming in on a consistent basis. So if Cameco is the only one buying, they're not going to really move the price. So I think that they're trying to be strategic with it. And when other utilities, fuel buyers, traders are stepping in and starting to pull that volume up a little bit, I think they're going to step in harder. Because as soon as that price starts to go into the 30, 35, utilities are going to start to contract in higher volumes, which moves the timeline of them getting McArthur River back online, which is their profitable asset that's shut down right now. So, they're not in the business of being spot market traders. That's not really what they want to do. And and so the sooner that they can get utilities back into the market for long-term contracts, the better off they are as a company. That's what I can tell, anyways. I could be wrong on some of that, but that's kind of what I'm seeing. Yeah. What do you think about that?
No, I kind of agree. They don't really want to be a hedge fund trying to do these arbitrage plays and everything. They want to get long-term contracts and bring MacArthur back on. I fully agree with that. So we're coming to the end of our time here. I would like to give you the opportunity to thank you, number one, for coming on. It was excellent information, as I expected.
Thanks. Yeah, my pleasure.
And what I would like to do is, tell people how they can get a hold of you. I know you have your blog. You also have a newsletter, and how you would prefer if people are interested in contacting you and checking your service out or asking you any questions or whatever. How could folks get a hold of you?
Thanks, John. Yeah, it's been a pleasure. I really appreciate chatting with you today. I'm pretty accessible through email, through the website, through Twitter. It's at Uranium Insider on Twitter. My website, uraniuminsider.com. I do have a free email newsletter as well. I put out some, just kind of some ramblings on the uranium market and various, investing ideas that I can't fit into a tweet thread. A couple emails a month, and then I have the newsletter. I give priority communication with the newsletter members, of course, but I'm a pretty open book. I'm happy to communicate. I have a lot of just fantastic dialogues with people through Twitter or through email. So any of those ways I can be reached, and I'm more than happy to chat with folks. Yeah, I really appreciate being on. Thanks, John.
All right, outstanding. And like I said, thanks again for coming on, and enjoy the rest of your weekend.
Thanks so much, John. You as well. Appreciate it.
Okay, bye.